Thank you all for the attention and for sticking through this. This has been a tremendous amount of work, and as I started the day, this is literally the best time to be CEO of this business. We are getting to make years worth of changes over a very short period of time. I'll bring back the message that I started with. In the asset management business, we have nothing but opportunity. This has been about focus. There are lots of things in the asset manager that we've elected not to do. We just have to do a couple of things well. They're all up on the screen or have been talked about today. We have lots of other choices. In the retirement services business, the team has been relentlessly focused on execution. It's now time to broaden what they do and think about retirement in a whole new context. But when I think about how daunting it is to go from where we are to the projection, I come back to this relatively simple slide. We are a small asset manager in the context of the world. We don't have to do all that much. I said to one of you in the hallway that if you look at our fixed income business, our credit business, it's roughly $550 billion today. Not all of that is alpha. There's mostly alpha, but there's a chunk of beta in there. For us to double that business, it's finding 300 billion of assets or 350 billion of assets over the next 5 years. I like our odds against this TAM and against what we've invested in. Any one of these 4 big planets here could double our business. We're lucky we have all 4. We have spent the better part of a decade, 15 years for some of the businesses, positioning ourselves for this moment. I wish I could say with clarity that we saw this coming. We did not. Changes in capital markets, changes in regulation, changes in competitive dynamics, changes in markets have afforded us this opportunity, and we find ourselves not just as a small asset manager surrounded by massive TAMs, but truly uniquely built to achieve what we need to achieve. And for us, we just have to make sure the culture's right. The goal is not to be the fastest growing. The goal is not to be the largest. The goal is simply to execute the plan, and as I often say, to like ourselves at the end of the 5-year period. We are really fortunate to get to do this. We have a tremendous amount of fun doing what we do. It is a small village. People know each other. We care about each other in the moments that matter. If you're going to be my partner, our partners, for your entire career, the number of good things and bad things that are going to happen to you over that period of time are going to be quite substantial. How we deal with you in those moments as an individual, massively important to maintaining the best partnership. So we're very modest. We understand the work that we have in front of us. We understand that many companies who have been successful are content playing not to lose. We're here to play to win, and winning for us is achieving the plan, but also liking who we are at the end of the 5 years. So thank you very much.
Great, so we're going to move into some Q&A. We have Marc and Martin on stage, and we have mics also for the other presenters as they may participate. If you could just please state your name and your firm, that would be great, and the mic runners will come around. First question to Craig, right here.
Craig Siegenthaler, Bank of America. Thank you for hosting a great event, and actually thank you for being on time too. That's not always the case. But my question was on the non-U.S. retirement business. I know you've had some success in the Japanese reinsurance market. I also saw you sold down Challenger, and maybe Europe is a little tougher these days, but I wanted an update on that business because you have several businesses there. And will we see growth from inside of Athene or from the other retirement businesses that you own?
So the question is on international retirement services. So I'll take a shot at that, and feel free to add, and Jim, obviously feel free to add. So Athene's mandate includes some international markets, in particular Asia. As Grant mentioned, there are now numerous treaties, and the large, well-capitalized, well-rated Asian companies like to deal with the mothership. That is their preference. They like to deal with the ratings. They like to deal with the continuity of the management team. So I would expect most of the growth, and what is in our 5-year plan, is pretty much focused on Athene and international markets. Challenger was, as I said on the earnings call, this was our chance to think about how to enter the Australian superannuation market. Australia has done an awesome job accumulating assets. They have done a less awesome job on decumulation. We actually think we can be really helpful in the decumulation business. We've developed really good partnerships with Challenger. It was not and is not our intention to own Challenger, and it turns out we don't actually need to own the stake. And the stake was, we made money on the stake, and we've since disposed of it. At least from Athene's point of view, Apollo retains a residual stake in Challenger. Same is true, by the way, for FWD. FWD is very aligned with Apollo from an asset management point of view. We are doing reinsurance. We're looking at portfolios together. But from Athene's point of view, that stake is now gone, or will be gone, and is now where it should be, which is with Apollo. In terms of the European business is quite a large business today. But I would say Europe is just a much more difficult place to grow a business. We've basically pivoted the management team at Athora to focus on reigniting organic growth. Because there's a series of opportunities. Inorganic transactions have proved to be politically very difficult in Europe, not just for us, but for everyone. Organic, there is a massive fall off in the availability of guaranteed income and retirement savings in the European market. And right now, the primary place we're growing organically is in the Netherlands with a little bit in Italy. We actually need to return the entire business to organic growth. We find ourselves in an interesting situation of a large, profitable business with massive amounts of excess capital, because we did a very large capital raise, which is still not deployed. And Europe itself is wrestling with interesting issues. The US, just to start, the US is the envy of the world. We raise 50% of the world's capital. Everywhere in the world, as I suggested, regulators have two choices as to where debt capital comes from, the banking system or the investor marketplace. Everywhere, they've told the banks to do less. It's just in Europe, they forgot to tell investors to do more. They're just starting to do that. The conversations around liberalization of securitization, liberalization of other private assets, are just starting. And that, to Jim Belardi's point, we only want to grow where we can earn excess spread. If there's no excess spread in public markets, you have to go to private markets. If the regimes are hostile to private markets, very hard to earn excess spread. And that's why the European guarantee market has virtually shut down. Not for us, for everyone. Okay.
Patrick.
My goodness.
Patrick Davitt, Autonomous Research. Another question on retirement, particularly U.S. retail annuity demand through the lens of lower rates. There are early signs that demand is shifting to RILA from FIA, and Athene has pretty low market share in that product. How should we think about your right to win in RILA versus some already very established players? And in that vein, do you think you can replicate the share gains you've made in FIAs with that product?
Grant, why don't you take a shot at that? Just grab the mic from Jim.
Grant. First of all, I disagree that RILA sales are coming at the expense of FIAs. They're coming at the expense of variable annuities, and both fixed indexed annuities and RILAs continue to grow. There were a few questions in there. Our right to win in RILAs, I think we have to prove it. RILA is the first registered product that Athene has engaged in. And so it goes through registered distribution, which we're still in the process of building out. As I said, I think we have a great product. Our RILA sales are growing more than 25% this year, but our market share is still modest. As you pointed out, it's 2%. On the platforms that we're on, we have 10 to 15% market share. So I think in RILA, it's about getting more at-bats, getting more exposure for the product, and we're busily working on that. I think the last piece was around interest rates. I've been asked this a couple times before. We don't know. I mean, we haven't lived through an environment where rates have shot up this much, and now we're trending down. But I do believe there's reason to believe that annuity sales will stay elevated. We talked about the tailwinds of an aging population. No one is forecasting rates going back down where they were. I think the consensus is 3% floor on Fed funds. I think our internal forecast is higher than that. And you also have the phenomenon of this money has come into the insurance ecosystem. They are now experiencing the benefit of tax deferral. And when the products mature, they will be offered a new opportunity to continue that deferral. So the short answer was I don't know, but I have optimism that the sales will continue to be elevated. Maybe MIGAs will come down. FIAs and RILAs have grown regardless of the interest rate environment. So I'm far more sanguine about the opportunity for retail annuities than some who've sort of implied that falling rates mean our market's going to shrink a great deal. I don't think so.
Glenn?
Thank you. Glenn Short, Evercore. So I'm fascinated with the thought process of origination is your lifeblood. Origination is what fuels your ability to win in all these huge TAMs. Yet at the same time, if you look historically, large originators trade at low multiples. They were either cyclical because of rates and the economic cycle, or they were really bad underwriters. So as you build out, and especially as you build these partnerships, A, can you avoid any of the cyclicality by diversification? And B, how do you avoid adverse selection with all these partnerships in terms of what you do take on?
So let's start with the asset management business, because I don't think origination is our lifeblood. I think it's everyone's lifeblood. I think if I'm right and we're right that public and private are going to converge to some extent, illiquidity premiums, structuring premium, they're going to disappear. Where you're going to get excess return is from originating product. Most people who have gotten into, if you originate bad product, you will have a bad business. If you are an asset manager who picks bad stocks and picks bad bonds, you will have a bad business. So it presupposes we can do what we do well. Why do people like doing business with us? Because we have skin in the game. We are 25% of everything and 100% of nothing. Everyone is making a journey. Yes, endowments and institutional investors have been invested in alternatives for a really long time, and they've developed a comfort level. But when you talk to family offices, to individuals, to insurance companies, when you start talking to the fixed income market, like in the room here, we just take this for granted. But everyone is on a journey of education. The fact that we own the product and that we are not a promoter of product, a salesperson of product, a bank who has no skin in the game, an asset manager who just gets a fee, is a massive part of our selling point. We go to market, purchase price matters, excess return per unit of risk, and the most aligned investor out there. I think that's to our betterment. And the final point really gets to quality control. When you consume the asset yourself, you are very concerned about what happens. Each of the platforms that we run, they are not captive only to Apollo. Every one of the 16 platforms that Chris Etzen gets up to care for each day, now with a massive team reporting to him, we want to retain third-party market access because it's a good discipline for ratings. We don't want to own 100% even of the platforms. We have invited seeming competitors of ours, MassMutual, others, Metropolitan Life, into ownership of these platforms. We never want a platform to be so big that we have to do business. Just like Jim and Grant talked about running Athene as a principal, we run these origination platforms as a principal. If we don't like the flow, we want to shrink it. If we think spreads are wide, we'll accelerate it. We compensate people not for what they produce, but for ROE net of losses over a really long period of time. There is no perfect outcome. There is no perfect alignment. But relative to a banking institution, relative to a pure asset manager, relative to a specialty finance company whose only business is specialty finance and therefore has to love their asset class every single day, we are the best we can be in the context of nothing is perfect.
Alex.
Thanks. Alex Blossing, Goldman Sachs. I was hoping we could spend a minute on your capital return framework and just double clicking into the $21 billion you highlighted a number of times today. I think at a high level, it feels like there's a lot of discussion around growth of third-party capital, which obviously comes with higher ROE and more capital generation. So as you think about the buyback and the toggle between some of the M&A opportunity versus doing more buyback over the next several years, what does that look like? What are the key considerations? What are some like inorganic things you still might need to add to? And just a clarification point, I think I heard you say you're using about 600 million shares throughout kind of your targets for 29 as well. I think previously you kind of talked about 600 by 26. So is that the case, and therefore 29 will be lower than 600?
Yeah. So a couple of questions. It's interesting. What we have actually spent on strategic growth in the last 3 years is less than $1 billion. So we look at what's in front of us today. It's all organic growth. I think if we do something M&A wise, it's likely to be niche-y tuck-ins that give us a new capability. But it's sort of easy to justify the math on the initial sum of the parts accretion. You then have to integrate the business, operate the business, and grow the business. And so we just don't, like where we sit right now, we don't see a lot of opportunity to be active in spending money, capital on M&A growth. So, that it's unlikely to change, I think. So, the share count is like there's plenty of capital. You can see like the reason we laid it out so clearly was to connect all the components between FRE, SRE, and PII, and then there's some borrowing capacity in there. So, we brought the share count down to 613 today from 617 to a month ago, and so 6 weeks ago. So, I think you should expect that we'll continue to take it down, and then we'll make decisions on where we go from there. But it's attractive. Like we run the math. M&A has to pass a bar of 20%-ish return. Buying back stock, we think at our growth rate does the same thing. So that's you get to the same place. We'll do whatever's more attractive.
So I'll add just the overview of this. Look, we're forecasting a plan that's out in the future where a portion of the capital generation comes from the good work of Matt and David and realizations in the portfolio, which have been delayed for an industry over a long period of time, and we're more mature than most and doing a better job than most, but still is uncertain. What we've done in constructing the plan is we've left what I'll call two levers in the plan. One is Athene's growth is up, but on a percentage basis, it's not up as much in terms of new business. Think of how fast Athene has grown from a new business point of view, and we're talking about going from 70-ish billion to 85 billion on average. The result will be significant capital accumulation at Athene because we've only assumed that there's a $750 million annual dividend, which is becoming a lower and lower percentage of Athene's earnings. And the reason I mention this is we have a choice. The ecosystem is growing faster. Anytime we decide to retain more business, we don't have to actually do more business. We just keep more of the business we're already doing and deploy some of that capital. So we've left that as a buffer because we will get a rainy day, we will get a cycle, we will get spread tightening, we will get things we don't like, and we want the flexibility to meet our commitments to you as we have over the 4 planning periods. The other is we have not assumed a return on roughly $7 billion of capital. We have a pretty rough framework. Given how much stock employees own, like we're very focused on stock and share count and on other things. And so we will, I assure you, get a return on $7 billion of capital, and that return can come from just buying back the stock with all or some of that. But I agree with everything that Martin said. I don't see significant game-changing M&A for us. That does not mean we will not do M&A. I could think about distribution. I could think about additional skills that we don't have, particularly as they relate to the high net worth marketplace. I can think of niche tuck-in acquisitions, but I don't see significant M&A on the horizon.
Mike.
Great, thank you. Mike Cypress of Morgan Stanley. Just a question on guaranteed income solutions that came up throughout today's presentation. Just curious how you see that developing, particularly in the DC channel. What might be successful, do you think, in terms of products, what that might look like, and what do you see as perhaps the winning strategies and approach from a distribution standpoint? I think there was some reference to target date earlier. Maybe you can update us on how you're thinking about that as well. Thank you.
It's good because you'll actually get debate amongst the team. So why don't you start and I'll voice over.
For the second time in Q&A, let me start by saying, I don't know. I think it's pretty early days, and we and others are trying to figure out solutions. It was Secure Act 2.0 that actually allowed annuities to go into DC plans. It is a very difficult ecosystem to navigate between plan sponsors, record keepers, product providers, target date fund managers, the legal requirements for liquidity and all the rest. Very difficult to navigate. All I can tell you is we're spending real time thinking about it, coming up with different ideas, thinking about pieces of the puzzle. A product like a SPIA, single premium immediate annuity, that we just introduced could be a piece of the puzzle. The future target date fund that I outlined could be a piece of the puzzle. We're in the market now as a parts provider to a solution being offered by ARS, which has a target date fund that qualifies as a QDIA, and where the target date fund, rather than migrating from equities to fixed income, migrates from equities to a fixed indexed annuity, and where that guaranteed income can be taken by the participant when they leave the plan. We think that's a superior solution. The market hasn't decided yet. Other plans that you've seen announced provide for income, but the individual has to select. And I think, as most of us in this room know, most people don't select. They set it and forget it. Over 70% of people in DC plans never make a decision to change anything after setting it up. So I think there's a lot of elements of it that are yet to be played out in the marketplace. All we're saying is we're throwing our hat in the ring, and we're devoting serious assets, people and assets to try to figure it out.
So in the plan is just what Grant said. Serious assets and people to get to guaranteed income. It is one of the things in the future. If you think about the public policy issue here, we have $12 to $13 trillion in 401k, and we're forcing these really long-term investors to own daily liquid index funds for a period of time, 50 years. Why, I can't tell you, but it relates to a vague notion that public is safe and private is risky. It's my belief that if we have a change in administration, we will have, in a very short period of time, illiquidity introduced into 401k. That will not just benefit Apollo, that will be another source of demand for the industry of a magnitude that will be quite substantial. The other is we have to reimagine what a guaranteed income solution is. One of the questions I ask, and I think the team is responding to, why is an annuity more than one page? Why shouldn't it just say that, Mike, you get guaranteed income for life, and it has a QSIP, so when you tire of it, you can sell it? It's not clear to me that that product should not exist. It's just not what exists. The second point I would make, so one point I make is product evolution. We cannot think of the existing product in the existing form solving the problem you're talking about. It's going to be a new product that it will be much simpler to administer. The other is, right now, annuities are so complicated that they are sold through advisor channels or third-party channels, and distribution costs can be substantial. When you deal directly with a fiduciary, like a target date fund, you are able to either increase, you're not paying a distribution cost, you can either increase the economics and make it more attractive, or you can retain a portion of that to hedge the longevity risk. And so I think, to Grant's point, the outcome that we can offer with access to private markets and guaranteed income is not 5% better or 10% better, it's 60% better. We're going to get there. We just can't tell you exactly how, but baked into the plan is very little of it.
Brennan.
Brendan Hawken, UBS. Two questions on retirement services. So you spoke to ADIP growing, but is it going to grow proportionally as a percentage of the capital supporting Athene? And then you made some changes to the alts portfolio that you spoke to, Martin. Is it now that it's just Authorable and Venerable in there, and so like Catalina and the other investments were gone, and maybe could you speak to the lessons learned from that change?
Do you want to hit the first one?
I'll do it. So in lessons learned, we, in international markets, particularly in Hong Kong and Australia, we started with the premise that these were really attractive markets. We didn't know if they were attractive as principal or as agent. We actually figured out that they were more attractive as agent than as principal. And yet we left the stake in there. So we had early appreciation, and then we kind of left it there. And as I said on the last call, the asset and the investment should follow where it benefits. And since it is an agency relationship, it left Athene and moved to Apollo. And in some cases was downsized and sold. I don't think there's any overall lesson learned, because you think of other relationships like Venerable. Venerable's been massively successful. On average, all the insurance stakes have been really successful. It's just a lot of that success played out, and in the quarter that we had negative mark on Catalina, and we had no appreciation on Challenger and FWD, and that created a challenging situation and forced us to just get after it. We did. In terms of the mark, when we started 15 years ago, we had a choice. Recall that Athene's portfolio is roughly 95% fixed income, of which 95% is investment grade, and 5% of it is equity. Most people, including our regulators, assume that as a firm that had its heritage in private equity, we would have put private equity into that 5% bucket. That, in fact, is what most of the competitors have done, and in addition to real estate equity. We decided that we wanted to have less volatility and more stability of return. And so we started doing hybrid transactions, as David and Matt described. And over the years, we're now circa 200 different hybrid transactions, fully diversified by vintage and by type. And AAA has performed really well. We like it because it also works well with interest rates and the interest rate risk we carry. Typically, we've seen tighter spreads when rates are declining. Typically, we've seen equity markups when rates are declining. It's not a perfect hedge, but it is a hedge, but without the volatility. So I think we're happy with it. I think you're going to see us continue to allocate 5-ish% to equity. I think if you have a complete repricing and debacle, we'll actually go up in percentage because it will be more attractive.
I know there's more questions in the room, but in the spirit of keeping on time, I think that's a good place to end. We'll finish where we started, which is we very much appreciate all the time that you've taken with us this morning to hear our story. And if you have any questions that went unanswered, please feel free to follow up with us directly. Thanks again.